Hi, everyone. Thank you for joining today's webinar with WisdomTree Senior Economist, Professor Jeremy Siegel, live on Trump's tariffs impact, where he'll be joined by Jeremy Schwartz, our Global Chief Investment Officer, Kevin Flanagan, our Head of Fixed Income Strategy, and Sam Rines, Macro Strategist of Model Portfolios.
Well, I get the pleasure of talking to Professor Siegel every week on our live podcast Behind the Market, but there's so much going on. You had called that we might get a correction before we had all this uncertainty with the tariffs, but now we have all these policies. Let's get your latest on what are the policies meaning for you? How does it affect your view on the economy, inflation? And everybody wants to know, is it time to buy with the sell-off? So we'll love to get your take on this.
I don't have to belabor how bad I think this tariff policy is. I voiced it. So let's get past that. This is a self-inflicted wound, unforced error. And by the way, today's employment report shows how strong we were going into this problem, but deteriorating rapidly. So first of all, let me go to the Fed, because if you were listening to CNBC, all of a sudden they said, "Oh my God, it's predicting 5 cuts by December." So my January Fed funds futures right now is showing 320. Current Fed funds 433. So yeah, it's between 4 and 5. Now, as I've pointed out many times, Fed funds futures are underestimates of what people expect the Fed funds to be. They're not unbiased. There are when you go almost a year out, 9 months out, you're probably talking about between 1 and 2 cuts. So I would say right now people are expecting about 3 cuts by the end of the year. But let me back up. The Fed should cut, and the Fed should cut no matter what the inflationary effect of this tariff is. In fact, I believe that I don't believe the price. We're going to get, next week we're going to get CPI, fine. That is, we're going to see that is pre-tariffs. But once the tariffs kick in, unless they're suddenly removed, but let's assume, the signal from the CPI or the PPI or anything is going to be very distorted. How much is demand and how much is tariff? The Fed should not react to a tariff increase. It should react to a demand increase. But that signal is going to be significantly blurred. Now, when a signal is blurred, it means you downplay its importance. So what would they be playing on? They'll be playing more on the employment situation, unemployment rate, etc. By the way, the latest, we're still not seeing it in claims. Claims yesterday came out again, right, and sweetly at 220. But it's going to be, employment is going to be more important, and they should lower it. And I'll tell you one reason why they should lower it. As you know, I look at the money supply. And the money supply has been growing, yes, but slowly. Year-over-year growth of the money supply is 4%. Last 3 months, about 4%. It actually had gone down to 1 or 2, but there were some revisions and been a little bit perkier recently. But still, 4% is a little too low. I mean, we had 34 years between 1980 and, basically the pandemic. So I guess it was 96 to the pandemic, where we had 5.5%. And that led us to a really good 2 to 2.5% inflation and approximately 2 to 2.5% real GDP growth. We need 5.5. So that's not that much higher, but it is higher. So the Fed can afford it. Lowering would not be inflationary because the money supply, in contrast to 2020 to 22, when the money supply was increasing 10 to 15% a year, is now increasing at about 1/3 of that level. So we can afford to increase Money by lowering rates. How do you increase money? You lower rates. That encourages loan demand. Now, I'm worried about loan demand shrinking, because if the economy shrinks, loan demand will shrink. And that's another reason to lower rates. So we may see the money supply begin to shrink because people won't take out loans. They're uncertain, because that's how the money supply increases. So the Fed has room to lower. And I think it should lower. And I don't think that's inflationary at all. Now, will that come to the rescue? It'll help. Would it cure the situation? No, as long as the tariffs remain on at these levels. It won't cure it, but it'll moderate it. Now, let's talk about levels of the stock market. We're not at a bear market yet. We could be. If these rates stay on and we don't see negotiations, and if we see retaliation, as we've seen from China that came across, at around 6:15 this morning. If other firms retaliate, I would say bear market is quite likely, not certain. Listen, no one can be a timer. Let's try to talk about long-term values here. I've lived through I don't know how many bear markets, 10, 15, if we get one. And I'm not saying we will, but, and I've seen stocks much cheaper than we are today. Even, what are we today if earnings are flat? Year over year. No growth at all. 20, 18, 19? That's a good rate. It's not a real cheap rate. It's not like when I saw it at 10. I don't think we'll ever see 10 again. And I don't think we should. Right? First of all, if interest rates are going to go down and they're not that high, we saw 10 when the 10-year was 16%, so we're not getting there. I've often said that I thought the equilibrium PE rate, I've said this for 15 years, is 20. And probably a little bit lower than that now, even with no growth. Yeah, growth is going to really, those estimates out in 2015, 2025, 26, they could really be brought down. But don't forget, and this is really important. I mean, stocks are the longest term asset. At 20 PE, only 10% of the value of a stock comes from its earnings in the next 2 years. So if you do a freshman finance question, I have a company and we will wipe out its earnings for 2 years. We're not doing that, and it goes then back to normal. How much should the price drop? The answer is 10%. You can work it out. Not hard. 5% is the earnings yield. You wipe it out for 2 years. By the way, do it with a bond. You're not going to get your coupon for 2 years. What's the price of the bond going to be? So in a way, anything, the history of the market is overreaction. Always. And that's built into the psychology of what goes on. Oh my God, earnings are down 20 or 30%. Now what happens if they stay down? Well, if they stay down forever, then the stock should be down 30%. Right? If they stay down forever, which they never have. Ever. However, if they stay stationary, when you're at 20 times earnings, you're at a 5% real return. with 3% inflation, I'm taking off the tariff-induced part of that, you're at about an 8% return for equities. That's still, what is the 10-year? Now it's below 4. 3.92. It was in the 3/8 earlier today. You got a nice equity premium now. Has it been bigger? Oh, yeah. Could it get bigger? Oh, yeah, could. But, let's take a look. Right now, 10-year tips is 1.7. A 20 PE ratio is a 5% real return. That's a 3.3% equity risk premium. If you go over all of history, it's about 3.5. And we're pretty much where it's been. Nothing much different. And that's enough to have accumulated. You do your math. 4% per year or 3.7% in your bond versus 8 to 9 on your equities. You know how much you're going to grow over time. But it's the volatility in the short run. And is there potential for more volatility? Of course. What about some long-lasting effects here? I mean, and I talked about those this morning on CNBC. There's going to be some effects that are longer term. I mean, even if Trump tweets tomorrow, oh, yeah, I'm taking them all off, there's going to be effects. People, when there's a shock, it takes a while to wear off. Oh, my God, could he do it again? What did that mean? What else might he do in the future? Well, can I trust what's going on? Is there a stable regime out there or not? What could force Trump to change position? Political. Really is it. I think there was one commentator on CNBC that said there's court cases that ain't going to do it. There will be court cases. There are court cases, but even if they're accelerated to the Supreme Court, saying, and by the way, it's on this issue that he declared an emergency. There is no emergency. I mean, when the bills were passed by Congress, it was like imminent war. And, you need to, apply tariffs as pressure. Well, that ain't really the case. So the question is there really an emergency or not? If that is accelerated to the Supreme Court, and there might be a district judge who says there's no emergency, stop the tariffs. Trump will ignore it and send it to the Supreme Court. What do you think the Supreme Court's going to say? It's Congress' responsibility. It's Congress's. If they think that Trump is outstepping his bounds, then they should pass a law. I mean, he's following it. I mean, by the way, he went through the steps. The steps is to go to the Department of Commerce, which of course he picks Lutnick. I mean, he picked Lutnick because Lutnick would agree with him. And they said, is it an emergency? And he said that's the only steps that were required. He went through the steps. Now, let's go on a little bit further. Actually, so let's talk about this. I'm not saying it's going to get to this point, but it's a tree point that you should think about. Suppose, and by the way, there were already 51 senators that voted against it, not in the House. But if this gets bad, you might get a majority in the House and the Senate. However, Trump will veto it. Well, what does that mean? Well, do you remember your civics? 2/3 of the House and Senate. Which means you'd have to bring, about 1/5 of the Republicans to join the Democrats, maybe a third of them. Is that possible? Yeah, maybe. Oh, well, if any of them go across, aren't they turncoats and won't they retribution? Well, not really, because if he continues these tariffs, the Republicans are going to lose in every swing district. So do they care that they're going to be primaried? They'll lose anyways. In fact, maybe the only chance that they're going to have a re-election is by switching against Trump. So that's possible, but not at this point. Maybe we could turn one congressman a day that as this deepens and deepens and deepens and the bad news comes out. But that's into the future. That could be 3-4 months. That's not an impossible route. But this idea that the courts can stop it is not going to happen. The Supreme Court will say, Congress, you want to stop it? You pass the law. And then it has to overcome the presidential veto, which, by the way, if you go through history, that's happened. Don't forget, the founding fathers gave the Congress and the Congress alone the right to set tariffs. But Congress then, in its infinite wisdom, transferred those rights over the last 60 years to the president, stupidly, in my opinion. And that's why we're in the position we are in now. Smoot-Hawley was passed by Congress. There was no option of the president back in 1930 to pass. It was impossible. It was against the Constitution. It wasn't even considered. So maybe Congress should take back its rights. Okay. I went that way because I wanted to think ahead for you a number of points. Let's also think ahead a number of points. What's going to be the polling results in a few months if the tariffs take effect and the prices rise? And everyone, of course. It's like that a price rise, whether it's caused by a tariff or not, will be blamed on the tariff. It's human nature, by the way. It's the same reason we get a storm and someone comes to you and say it's global warming. It's human nature to do that. And it's going to be fixed in people's minds. Well, that means, I don't like Trump's tariff policy. That's causing a rise in price. And of course, the mainstream media is more than happy to amplify that sentiment. That's not good for the Republicans in the midterm. Now you say you don't care. Okay? So maybe the Senate and the House in a year and a half from now switch. Still got the president for 2 more years. Does he care about his successor? Or, like what happened after the Smoot-Hawley tariff, they threw everyone out. You see, that's actually the biggest danger, is people get a bad taste and turn to the Democrats. Because let me tell you that even if Trump gets his tax cuts through, and we don't know the form of that yet, and it isn't done yet, and there's lots of steps yet. If we have a Democratic Congress and president in 2028, he or she could totally undo it. Absolutely. Now, I don't think we're going to have tariffs for 3 years, but again, on the first day of a new president, he can totally undo it with executive orders. unless Congress passes a law with 2/3 majority to take back the right to tariffs. And it would need 2/3. It would need defection from a certain number of Republicans. So I'm just telling you, I'm trying to give you some long-term perspectives on potential outcomes over here. Now, let's go back a little bit. I mean, I follow politics as much as I follow finance and try to jump ahead many steps on what potentially can happen. Trump is going to get negative feedback. Maybe not care at first, but if the polling turns bad, and I think it will, especially if he keeps it on, he'll need an off-ramp. And of course, listen, Trump is a master at creating off-ramps. He's going to get some calls from some economic ministers of some of these countries. Hey, listen, I'll take the tariff off of chocolate, so I'll take tariff, and then he'll trump that up as a victory. That's his off-ramp. I got 15 calls. I've reduced tariffs on this. We're going to negotiate the others. I started the process. That's the off-ramp. Whether he actually did or not is irrelevant. But he has to feel the pressure to do that. Will he? Or will he feel that pressure to do that? I think so, especially if a number come to him. Especially if a number of congressmen, Thune comes to him and says, let's say a month from now, things are bad, comes to him and says, listen, I'm sorry, I've got 10 Republican votes, or 12 to take back tariff rights. I could overcome your veto. Whoa. You're powerless there. That's what the Supreme Court's going to say. You're powerless. It has to do it in the House and the Senate. See, that we're not there yet. But I'm giving you scenarios over here. Again, this is in the context of all this commotion and disruption that could be substantial. Again, what happens in 2 years is, 10% of what the market value is. Now, however, if he persists and the country turns, we have to remember that although Trump is fond of calling his election a, overwhelming mandate, we know it wasn't. It was a good victory. And a lot of people like a lot of things that Trump said. And by the way, a lot of people, including myself, like a lot of things that he's done, except for tariffs, which I opposed from day one, from campaign one, but except for that. So, but nonetheless, it was, if you go through, the numbers, I mean, we used to call a landslide election something like 60-40. I mean, there was no landslide. It was, from historic people, going back in history, we call, whoa, this is a close election. You don't need much of a change to get Democrats everywhere. And unfortunately, Democrats everywhere can undo the taxes. You don't have a blocking. If you held the House, you held the Senate, you could block it always. A repeal of something. And by the way, one thing that is permanent, the good thing is that corporate tax cut. Now, he wants to go further on this, but all those others have expiration dates. which is another thing. He wants to get them permanent. I don't know whether he will be able to get a permanent with the deficits and all the rest. So the question really is a political question of the tax cut. You know, on day one, I said he got to drop the tariffs and go for the tax cuts. Okay. Maybe he'll regret doing that. Nonetheless, you know, again, for long-term investors, I like this market. I've seen cheaper. Doesn't mean I see double-digit gains. And as long as tariffs are on without, you know, a substantial mitigation, you know, I don't see much upside early on. Bonds are a hedge. Long-term, they're terrible. They'll cushion your short-term portfolio if you want, depending on how you interact with others on that issue. I'm sorry. I've talked a long time, but I wanted to give you a lot of scenarios and a lot of context over here. I'll take questions.
And we know the market opens soon, and the professor had a good opening comment. We'll continue for a little bit if people stick with us. Maybe let me ask Sam a quick question on where, you know, the professor talked about the negotiations, people calling in. Sam focuses on a lot of this geopolitical dynamic. Who do you see as the first one calling to get some of these deals? There's some talks of Argentina being the first to try to get to a deal. How do you see these other countries interacting?
Sure. So Argentina does appear to be the first one that made a phone call. It doesn't really matter. It's just not a large enough economy or an economy that has its act together in a way that is going to move the needle for anything other than Argentina itself. One of the major complaints for the Trump administration was that Argentina didn't allow U.S. beef imports, and it was costing $200 and something million to U.S. farmers. That's nothing. We already saw China retaliate. They're obviously not going to jump on the phone and attempt to get something done. But I would not be surprised if you saw India, Mexico, Japan, South Korea, close U.S. allies that have negotiated either very recently with the Trump administration, in the case of Mexico and India, or very close allies. Those are the ones that are likely to get on the phone and likely to be the ones that, one, have negotiating power on both sides in terms of the trade relationship, but also have a friendliness, right? There's an interaction that can happen there. One of the interesting things is right before we slapped the reciprocal tariffs on India that were rather large, we had just had a free trade negotiation meeting over the weekend where the readout on both sides was highly positive. So I do think there's a number of things that are probably already written down, sketched out, that can very easily be implemented on the Indian side, et cetera. So there's a number of countries that are likely to be making phone calls, likely to know what the Trump administration is looking for, and pretty easily at least get a minor stamp of approval pretty quickly here. It's worth remembering, these don't go on until April 9th at midnight. So there is time to negotiate around them. One of the comments out this morning from the Trump administration was, his policies are never going to change. And it's been overlooked that was largely about China retaliating, right? And it's pretty obvious that the Trump administration is not going to change its stance against China anytime soon. That's probably just going to be, call it an escalation, not a de-escalation part of the tariff thing. But again, the more uncertainty you inject into the system, the more you're going to have multiples compress, and you get a wider band around those expected earnings. You put those two things together, it tends not to be great for equities.
Professor, on the bond side, we've been talking about an active passive barbell using Treasury floating rate notes as kind of like the cornerstone. We've gotten a lot of questions. There's a lot of anxieties out there. In terms of navigating in the equity market, we hear your emphasis on stocks for the long run, but for now, in the short run, in the equity market, when you're thinking about sectors perhaps where you could navigate or maybe hide out through this process, what would be your recommendations?
Well, I think, certainly we've seen a reversal of the growth value trend over the last 2 months. Started really earlier, I think, than the tariffs, but accelerated on this tariff talk, so because those were the more risk-sensitive type of assets. Obviously, if we're going to have lower interest rates, I do think that does help our dividend products a lot. And what would you rather have, a 3% treasury with no inflation escalation versus a 3% dividend yield of a stock at a reasonable price that can move its price up over time with inflation, as history has, absolutely confirmed? They're very attractive. So those sort of strategies, as well as, you take a look at those stocks that did well yesterday as ones that may be more stable, as something that you definitely can do. But I think, again, the lower interest rates will finally help those stocks. Now, let me say the following. The negative on the dividend stocks is their sensitivity to the economy, because the probability of recession has definitely gone up. So if their earnings might be hurt more, now they can still probably maintain their dividend depending mostly, but so you've got the dividend yield. So those that have been dividend yield cut resistant through economic cycles might do extremely well during this period. Again, and I think what Sam, was saying was interesting. He could be taking some phone calls and tomorrow say, I'm taking phone calls and I'm going to lower this, and then optimism comes back and you will see a snapback. You will not see a snapback back to the highs that you saw in February. But you will see a big snapback, and it can occur any minute because, it appears that Trump's tweets are, completely, uncensored or looked at beforehand. So it comes to mind and he tweets it. So you have real live information, and could happen at any time, and you get a big bounce back if that happened. So if he's taking these and is looking for an off-ramp, we could see a rally. And you see them in the risk assets first, the ones that have been sold down the most with the high betas. The high beta assets will always jump first. So, and I see, so, again, it's such a volatile situation. I'm trying to, get through this volatility. It's a great long-term hold. To move your clients more towards cash or bonds, and he tweets one thing there, you're going to miss 2,000 points on the Dow in 10 minutes. And, there's no solution to that conundrum, because that is the risk of holding equities and having second-by-second quotations of equities that people get scared about. And, this has been true for 200 years, and it's absolutely true now and no different.
Professor, one of the questions came in on the tips rate that we talked about, 1.7 tips, the inflation levels, and how you do that for your equilibrium PEs, like factoring in where our inflation, let's say inflation goes up 100 basis points, how that factors into your sense of valuations and tips yields.
Well, the tips will take care of that inflation. And now it's 1.72. But stocks take in inflation too because they're real assets. As anyone who is, I usually start out my presentations, long-term presentation PowerPoint with the slide that shows that long run stocks are perfect hedges against inflation because they're real assets. So when you're taking a lot of long-term returns, a 20 PE is a real return. That's a 5% return on capital after inflation. 1.7 is the after inflation rate of return on tips, no matter what the inflation is. That's a 3.3% margin now, which is almost exactly the historical average. Period. And that average has given your wealth, those in stocks, the great wealth advantage over bonds over the decades.
And you talked about the trend in that Mag 7 and tech versus everything else. You mentioned interest rates being good. Is it, as you think about what's going on today, in the Mag 7 selling off more than everything else, do you have a sense why you think that is? In some ways, you say they're insulated from the tariffs.
They're insulated from the tariffs, but not from buying the tariffs. I mean, and it depends on what they're selling and who. They're selling chips. And then they're putting them in computers that are sold from China. Then and if there's going to be a recession, everyone's demand for everything goes down. I mean, it's not just a tariff. If the tariff induces a recession, and if it goes on long enough, I think the probabilities are over 50% it will. If it does, then everyone is affected because you just slow down spending of everything. From chocolate to cars to everything else, all of it. Now, some get slowed down less. Consumer staples get slowed down less. Discretionary more. Luxury items, luxury item depends on the stock market a lot. The real estate, etc., is very linked to stock. High-end real estate is totally linked to stock market. Now, we're going to get lower mortgage rates. Helps the very low end, but not if they fear they lose their jobs. That's not going to help them in terms of that market. So, the problem is the business cycle affects everybody. Now, what does the decline of the Mag 7 versus the other stocks is two things. One is their beta is greater than 1. So in any market movement is amplified by just by their beta being greater than 1. But the second thing is something that we've discussed many times, and that is their cracks in the AI narrative. Are there? Are the moats that give them the margins that are so high still attainable in the long run? Or is there going to be, is there going to be a BVD? I mean, is there going to be BYD, not BVD, BYD for the Blackwell chip? That, so we have a rival for the Tesla cars that have produced as cheap as Tesla in China, which no one else could do. Can there be a rival for the Blackwell chips that are just as that is a fundamental question. And for other cloud computing and other computing needs. Not that AI won't be demanded, but can it be demanded with the moat that we had before? So there's two scenarios there. And that's the one is a breakdown of the AI narrative, and the other is the high beta. And that's why we've seen underperformance of the Mag 7 versus the market over the last 2 months.
Professor, one of the questions that came in, taking it out of the U.S., what about Europe and what's going on there with respect to perhaps finally opening up their purse strings on defense spending in Germany? Could these be offsets for them on the tariff side? Do you see any opportunities?
Yeah, absolutely. Absolutely. I mean, they needed a kick in the pants to get their economies were sinking before the tariffs. Overregulated economy, not an innovative economy, over-reliance on the United States, all that. And, to the extent that they now wake up, if I'm going to do something, I got to do it on my own. I mean, that's a positive, in my opinion. And defense is one of the things they have to do on their own.
Where do you think Japan falls in the mix?
That's harder for me to read at this particular point. They got reasonable prices there. It is the oldest society trying to, get back its mojo that it once had. I don't have a strong opinion.
Tim, do you want to add any view on that for some of how you put in some of your models?
Sure. I would say that it's often overlooked just how forward-thinking the Japanese companies were, right? Because the Japanese market is different than the Japanese economy in a lot of ways. Toyota built a plant in Georgetown, Kentucky, where it manufactures a lot of cars. It has other plants in the U.S. as well. Suzuki, I think some of us can remember back to when they had the small SUV that they sold in the U.S. Before they left the market. But they're one of the they have the largest market position in motorcycles in India, right? And so a lot of these Japanese companies were very forward-looking, right? They didn't want to rely on the Japanese economy for their earnings, for their outlook. They very much stepped out and said, we would much rather have the demographics of Kentucky than Tokyo. And we would much rather have exposure to the growth of the Indian economy than the Japanese economy. So I do think that there's a lot of things under the surface that are getting very interesting at these levels as things get sold off without necessarily doing all the work underneath the surface on what's really going on with these companies. What are they really exposed to? How much is it really going to affect them vis-a-vis the tariffs, et cetera? So there's a number of things under the surface that I think are getting very interesting here. But there does need to be a lot of work put in to find those opportunities.
Professor, maybe we'll give you the last word on, I'm sure we'll, as the markets continue to have volatility, we always come back to you. We always give your book, Stocks for Long Run, as the long-term thesis. But as we navigate through this cycle.
I mean, the main thing is keeping your people in the market. I mean, you may want to rotate. You may want to emphasize some dividend-paying stocks as diversification. And it depends on your clients' sensitivity to short-term fluctuations. But, it's tempting to go in bonds. They've been negative beta over certainly this fall, as they are generally. But I think you should emphasize, that they are not great long-term investments and never have been. And that when this period of volatility is over, we have to deal with the deficit, inflation, and all that. And I don't think 3% bonds are going to last.
Final word, Professor. It's always great to get your take. Thank you so much for doing this call. I'm sure we'll come back as we have more market volatility this year. Thank you so much.
Happy to join you. Thank you.